So we've all heard of the word monopoly, which is a situation where a single company or group owns almost all of the market for any given type of product or service. So the question for you is, a monopoly, is it a good or a bad thing? Well, it's the way you look at it. I mean, if you're a consumer, then it's bad because the company gets to dictate its own terms, conditions, and prices. It's like how Henry Ford once said, you can have any car you want as long as it's black. If you're an employee, some monopolies can be good and some can be a bit nasty, and it's generally observed that small businesses don't do well in a monopolistic setting. In fact, many studies have put forth the argument that competition has weakened across industries as a handful of superstar firms are exerting more market power than before. And perhaps the most glaring example of this is the tech industry in the US, which today is an economic powerhouse, and the top 10 companies continue to cement their domination by gobbling up competitors. Even in our country, we are seeing groups like Tata, Reliance, and Adani's aggressively acquiring companies to corner a big meaty chunk of the market for themselves. Now, I don't want to sound like an activist, and to prove it, I can say that monopolies have been very helpful for at least one strata of the society, and that of course is the investor community. The shareholders in these monopolies have greatly benefited from industry concentration, as it has led to substantial earnings growth over the years, and consequently it has given them sizable stock market gains. And that made me wonder, how would a portfolio of just monopoly stocks perform, at least on a historical basis? And come to think of it, a monopoly has all the right ingredients in it. There is low competition, and in some cases there is no competition. The profit margins are pretty high. The sales growth is strong and sustainable. It has a recognizable brand. It has a wide moat. Its business is geographically diversified, etc., etc. And to top it off, many monopoly and duopoly businesses have done extremely well in the stock markets over the last many decades. Again, I look back at the US example, and the 5 largest companies, which are all monopolies in their respective categories, these 5 companies make up almost 20% of the market capitalization there and have delivered a CAGR of 28% over the last 10 years. So as an investor, there is a lot to be excited about, and hopefully this video will make you think on those lines as we go through a list of Indian monopolies, as we examine their performance parameters, and most importantly, we'll create a stock selection process using some of the strategies we have learned in other videos on my channel. That's going to be our quest for the day, and if you like what you see, then do show your appreciation with a nice, big, happy thumbs up. And let's begin. So monopolies are everywhere. We find them in traditionally nationalistic sectors like oil and gas, metals, defense, etc. And in other sectors like automobiles, pharma, food, logistics, chemicals, and in a lot of consumer-facing businesses. In fact, as these sectors continue to grow, it is likely to create even more monopolies. The auto ancillary industry is a prime example of that, with 1 or 2 companies specializing in a particular component and emerging as the market leader not only in India but also all around the world. So this can be a bit all over the place, and to keep it simple, I did what any pragmatic person would do, and I cheated. I mean, I quickly browsed through some articles and YouTube videos, and I put together this list of 20 companies that happen to have a market share of at least 50% and even up to 100% in their participating industry. Now, I'm sure more monopolies can be added to this list, and please feel free to do that. But as a portfolio, I think this list is pretty diversified, and intuitively it seems these companies have held on to a high market share for many years in the past. On my part, I have not applied any particular selection or rejection criteria on this list, and on a performance basis, this group of 20 randomly picked monopolies have delivered a 5-year CAGR of 18%. In comparison, the Nifty 50 delivered a much sedate 11.1% during the same period, giving the monopolies an impressive alpha of 7%. In fact, what's more impressive is that this 18%, it does not include dividends. So when I add an additional 1.52% to this random pick of monopoly stocks would have actually delivered a CAGR of about 20% over the last 5 years. Now, I've used this word random a couple of times now, and just to ensure it wasn't beginner's luck, I even clipped the outliers, the 3 best and the 3 worst performers. And still, this monopoly portfolio delivered an annualized return, an ex-dividend annualized return of 14.7. So the numbers are impressive, but what will really help us as investors is if we can identify the key characteristics and use that information to improve our own stock selection capabilities. And to help us in this quest, I'll be using some of the more important metrics we had learned in my earlier videos, especially the ones on coffee can investing, Peter Lynch's stock selection method, and the one I published earlier this month on Ambit Capital's multi-bagger portfolio. Now we'll be examining a total of 7 metrics, and just to make the data more readable, I have sorted the companies per their 5-year returns, with APL Apollo Tubes doing the best while Coal India was the worst performer. Additionally, instead of looking at present day data and then backtesting it, I did something better. I decided to forward test it this time. That is, I manually pulled out the data for each of the 20 companies from the 2017 period so that we can take some decisions in the past based on past data and examine the results in the present scheme of things. I hope this makes sense. So let's start with criteria number 1. Okay, numero uno is sales growth, and understandably, the higher it is, the better. As we can see this in this table here, most monopolies had grown their sales in the 2012 to 2017 period, and the ones that continued their good performance over the years were rewarded with superior stock market returns. On the other hand, monopolies whose sales growth was low in that 2012-2017 period, well, their stock price didn't do well in future years, with the notable exception of Navin Fluorine International. But generally, and as we have seen in other screener videos on my channel, a strong growth in sales is an essential requirement for good stock market performance. In the same lines, the next criteria is EPS growth, that is growth in the earnings per share. And barring a couple of exceptions, monopolies that grew their EPS in the 2012 to 2017 period and have continued that trend did very well for their shareholders. So if you love playing the odds and the stock market is all about probability, then opt for monopolies whose EPS is growing at 15% or more and is growing at a certain level of consistency. The third factor is the PBIT margin, and I was a bit surprised to see that the results were generally scattered here and there. For example, a monopoly like Hindustan Zinc has always operated at a PBIT margin of 45 to 55% in each of the last 10 years. And in spite of this big number, the share price has remained flat over the last 5 years. Of course, I should point out that Hindustan Zinc has been giving dividends rather generously in the last 2-3 years, but it still doesn't correlate well with a PBIT of 55%. But remember, we are not doing this exercise in March of 2023, we are doing it in 2017, and if I can be truly honest, after examining the sales growth, profit margin and the PBIT margin, I would have probably invested some money in Hindustan Zinc. It would have been a below average investment, but stuff like this happens, and there will always be some stocks that will fall through the cracks, which is why it's important to have a bouquet of monopolies in your portfolio. Anyways, what I can conclude from this table is that the PBIT margin is not a super strong indicator of future stock price performance as I had previously imagined. The fourth criteria is the capital employed turnover ratio, which is a company's sales divided by its average capital employed for the year. Now, one has to be careful with this metric because A, it is more suited for manufacturing rather than service companies, and B, it can be deceivingly high for the more established firms as opposed to smaller yet capital efficient companies. But as an indicator, higher the capital employed turnover ratio, the better is the stock price performance, and we can see shades of that in this table. The fifth metric is the PEG ratio, and if you recall what Peter Lynch said, a PEG ratio of less than 1 means the stock is undervalued and anything higher than 1 is overvalued. Now in this table, we don't have anything within the 0 to 1 range, but there is a bunch of companies in the 1 to 1.5 range, and these monopolies have generally given good returns, which means there's a lot of efficacy in this metric. Having said this, personally, I am not a big fan of a multi-factor ratio like a PEG ratio that uses the P ratio and the earnings growth. And at best, I would use it more as a broad indicator rather than a selection criteria. The next factor is the debt ratio, and I could not find any demonstrable pattern that a low debt ratio leads to better stock market performance. Please note here that I have taken the total debt in the company divided by the total assets, which is a stricter measure as compared to dividing the long-term debt with the assets, which some other publications use. The seventh metric is the return on capital employed, and contrary to what I've heard in some YouTube videos, a very high ROCE need not result in better capital appreciation, or at least that's what this data is showing. But what this data also tells us is that One, monopolies generally have a decent ROC, and except for Bharat Heavy Electricals Limited, all other companies had an ROC of at least 13% in 2017. And secondly, when we pick companies, when we pick monopolies, we should aim for an ROC of at least 20% to improve our odds of picking a strong performing stock. So this 7-factor framework is how I would have looked at monopolies in 2017 using a standard stock screener. And my idea of doing this exercise was not to be biased in my stock selection or to torture the data during the backtesting process. In fact, I looked at the sales growth, the EPS growth, the ROC, the PEG ratio, etc. And assuming I was in 2017, all this while, I went ahead and graded each of the 20 monopolies in 4 different buckets. There was a little bit of subjectivity here, but broadly, grade A represents monopolies I am most comfortable investing in. And let's say I invested 3 lakhs in each of these grade A companies. Grade B means good but not great, and so I would have invested 1 lakh each. Grade C are the potentially poor performers, and I wouldn't have put any money in them. And grade D are the worst of the lot, and I would not have touched them with a 10-foot pole. Which means of the 20 monopolies I had in 2017, I would have invested in 9 of them, which comes to a total of 15 lakh rupees. Now that money, those 15 lakh rupees, as on the 20th of March 2023, would have grown to a little under 50 lakhs, giving me an annualized return of 27.2%, and that too without factoring dividends. And notice here, I did some mistakes in my stock selection. For example, and based on what I saw in 2017, I would not have invested in Navin Fluorine International, and in the process, I would have lost out on a CAGR of 40% from this single stock. Similarly, I lost a bit with CDSL and Titan, but the selection process would have also helped me identify some excellent investment opportunities like APL Apollo, Balaji Amines, IEX, Asian Paints, Pidilite, etc. So you win some, you lose some, but at an ex-dividend return of 27%, I would say this methodology, this approach does show a lot of promise. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Alright, so there were 2 main learnings from this exercise. Number 1, a portfolio of monopoly companies has a better chance of outperforming the broader markets, and we proved that when a group of equally weighted random monopolies gave us a 7% alpha over the Nifty 50. The plausible explanation for this has to be around the inherent strengths that most monopoly businesses carry. 0 or less competition, an established business, a brand name, pricing power, systemically important, etc. The second learning from this video is how we can set up an intelligence layer to pick a better portfolio of monopoly stocks. And again, we did that with those 7 metrics, and without having the benefit of hindsight, we were able to deliver strong returns. If you're keen to do this exercise by yourself, then help is available. Because in this video's description is a worksheet that not only has the 2017 numbers for those 20 monopoly companies I discussed earlier, but I've also compiled the latest 2022-23 numbers for the same 20 monopolies that you can work upon. I would encourage you to download that worksheet, add additional monopolies to it based on your experience and from what you read, and try to improve the process further. I sincerely hope you found this exercise profitable and useful, and if yes, then don't forget to give this video a thumbs up. Do share this video with your friends, and I'll see you 3 days from now. Until then.